The honeymoon with cannabis is over. Value is no longer hinged on how much you can grow, but what you can do with the raw material afterward. Downstream products are where it's at, and companies like 1933 Industries, TGIF.C, have made that shift successfully, boasting well over 100 SKUs in California and Nevada's massive legal cannabis markets. EQUITY.GURU's own Chris Parry sat down with company CEO Paul Rosen to get a closer look at the company and its prospects over the next 12 months.
And just break right in here and go for it. Welcome to the EQUITY.GURU video Zoom interview series. I've got Paul Rosen on the camera here from 1933 Industries, otherwise known as TGIF, sort of a throwback from the old times. Paul, you've sat down in the big chair at this company at a time when it needed perhaps a little bit of intervention. The reputation was always good people doing good things, but were they getting a real sense of themselves out to the market? Were they taking a little longer than they should to get to cash flow positive? Did COVID come along and put a poleaxe through everything? There's a lot of questions out there. And what we like to do is to put those questions right to the big man rather than letting the people on the internet assume the answers. So I'll lay the first big question on you. Is everything going to plan at 1933 right now?
There's your succinct answer. That is to say that, first of all, hello to your audience. Hello, Chris. Great to be here. I really appreciate the forum. But when I did take on the role of CEO, I had in my mind a very clear path of action that I thought was essential, if not urgent, to return this company, which had and always did have great promise, back into essentially the winner's circle. And I can certainly unpack what that plan was. It's a plan that probably anyone that pays close attention to the cannabis industry has seen repeated at a number of companies as they've had to struggle with balance sheet issues, operational challenges, and overall sort of a slightly bearish sentiment that had blown into our industry starting, more or less in the spring of 2019. And I mentioned that day, Chris, because that's when I actually became an investor in 1933, a little bit over a year and a half ago. And to your point, I like the team, nice people, hardworking, a lot of knowledge. But, these are complicated, challenging businesses to run, and you've really got to have skill set in a number of areas, which is tasking any executive team with a lot of challenges. Where I will say there were some challenges that started to erode the value of the company had to do with the balance sheet and, quite frankly, a number of quarters of declining revenue. And some of that can be heaped on into the COVID corner. There's no doubt that had a seismic shock on the Nevada asset, but it would also be fair for anyone, paying attention to financial reporting to point out that there was previous 2 quarters of revenue decline before COVID was such a thing. And so that caused me some concern. So when I took this engagement, I had sort of a three-stage course of action that I thought was essential to return the company to a more stable and hopefully growthful platform. One was to get some relief on the balance sheet, and specifically, I had noted that the company had outstanding convertible debentures in about $11 million or so Canadian, that while they were not due for about a year and a few months, just to me were an unnecessary overhang on the industry, and the price that they were going to convert at was so far out of the money that there was no expectation of conversion, and really you could consider this as just conventional debt. So I sought and passed at a debenture holder meeting a number of resolutions that immediately gave the company some relief. First of all, there's a voluntary option to now convert debentures at a new price of 10 cents a share, and happily approximately a quarter of the debenture holders have so far availed themselves of that option. So that means that that debt is reduced, and also the interest carry is associated with it is reduced, and I'll say to some degree could be viewed as a vote of management confidence in that the option price is still above the stock's current price. Second, very important, we passed an amendment that allows the company to defer all interest earned under the loan until the end of the loan, which is now a year away. It was actually September 30th, 2021. So we just passed the 1 year milestone. But while the burn for cannabis at 10% wasn't egregious, I think we've all seen interest rates well above that. It's still precious cash flow that is better kept in the company right now to grow the company than it is to disperse to debenture holders. So happily that amendment passed. Third, the company's management was granted the discretion to pay that interest when due using either cash or, at discretion of management, the alternative currency of the company's stock set at 10 cents a share. And then fourth, and finally, we reset the price of the mandatory conversion. If the stock now trades at 15 cents for 10 consecutive trading days, it will force the conversion of all the debenture holders who haven't voluntarily converted. So that helped us on the expense side in terms of taking off the interest and ultimately lower the principal that will be due when the interest comes along. It should also be noted, Chris, this is important, that debenture is unsecured. It's a very important distinction for those in the industry, because we could look at a company like Ianthus Capital, a company that I was on the board of for 3 years, but they are now essentially being taken over by the debt holder because there was secured senior debt. So we're going to, hopefully more than exceed that 15 cent stock price to convert all the debentures. But even in a scenario where we're not able to, usually we know that this is unsecured and we will bring the debenture holders under heel one way or the other. Secondly, to continue on the balance sheet, we did a capital raise. We raised about 800,000 Canadian dollars by selling units of the company. Each unit was purchased at 7.5 cents a share with a half warrant option for 2 years at 12.5 cents. That actually was meaningful amount of working capital. According to our current burn rate, that's several additional months of operating capital. And then we went right after the expense side of the business, because the truth is, while I don't doubt the great intentions and the vision of previous management, I think cannabis has had a very important pivot, which is a race towards profitability. And sort of these long tail bets that companies that we all know by name, including companies that I had a leadership role, made investing in potential growth that was not in the here and now. We've seen a lot of those investments or those strategies unwound, and what we've seen is an appropriate focus on profitability. So myself and my co-executive, Gene Ruiz, who's quite a talented CPA CFO type, we went through every single expense item that there was, and unless it immediately could be connected towards short-term or near-term profitability, and it was discretionary, we cut it. So we have significantly cut the outlay that this company was enduring in less than 4 months. And what that means is that our balance sheet is stabilized now. Our cash position is largely stable. We're not burning through anywhere near the capital we were even in the most recent quarter. And now that takes us to our third sort of plank here, which is improve the balance sheet, improve the expense side of the company, and then improve overall management towards selling more and more product. I'm sorry, this is a long answer, but it's a complicated question, so I should pause for a moment. But if it's okay, I just want to keep going on a bit of a roll here. One of the challenges the company faced was that the company previously mistimed the shuttering of their existing cultivation facility with the reopening of a much larger, new and improved cultivation facility. And just to be granular, the company was previously operating in a mixed-use building measuring 12,000 square feet. Half was for cultivation, half was for concentrates. It was our extraction lab. The company was in the midst of bringing on a new cultivation facility measuring 68,000 square feet, making the original cultivation zone of 6,000 feet essentially moot and not necessary. But unfortunately, due to permitting issues and just the Las Vegas licensing authority and the fire marshal being a little bit overwhelmed, it took us quite a few additional months to get that building up and running. Meanwhile, previous management, I'm sure with good cause, had made the decision to essentially stop growing plants in the old facility. The result of this is that we have not had our own kind of domestically grown flower out of 1933 in almost a year. And flower is still the number one form factor in Las Vegas and Nevada. It's still where the highest margin is. And so these combination of factors really put the company previously under some pressure. Revenue is going down, new building not open, COVID having a dramatic impact, spending too much money, dealing with the debenture. And now 4 months later, our new facility is not only up and running, it's optimized. We're on continuous cultivation. We're predicting between 500 up to 550 pounds of flower a month. That's dry. That's not our wet. Our wet's like 3,000 pounds. And that's not even fully optimized. We still can add another 90 lights or so to that building. So, this was a company that had all the potential in the world, that still has a very strong recognition and a brand in the Nevada market, but it just needed to be improved in terms of the day-to-day management and most significantly, the financial sort of discipline to exercise that day-to-day management. Again, previous management, there's all wonderful things I can say about them. There's much about the plant that they probably know that I don't know, but as a fairly mature business executive now, when I looked at the balance sheet and I looked at the revenue we were producing, to me, it wasn't that complicated what we needed to do. And happily, we've done it. We've executed really, really well. I give full credit to the Debenture Holders for their faith in new management. And now we're starting to look at a major improvement in terms of where the company's revenue is going to grow. So the short answer was yes. And then I just gave you the very elaborate answer.
We'll edit all that out anyway. It's all right. So there's a few things to touch on there. I think one of the things for me that's important is that we've all seen companies get absolutely pounded out by debenture holders who are in a position to dictate terms. Certainly IANTHUS, like you mentioned, MedMen is a shadow of its former self. There's a lot of companies that take those debentures out in the hope that they get to that place. Which you've certainly witnessed in your time in this space. So getting the other side where debentures are actually impressed enough with your plan and who you are and what your track record is to allow you to the room to move to execute, that's certainly a big plus, I would think, especially now.
Yeah, I give a lot of credit to the debenture holders. It wasn't like a big kumbaya session the first time we sat around and talked about it. But to me, I thought the debenture holders were more or less in terms of outcomes pari passu with the equity holders, meaning we can all rebuild this company, if you will, and set it up for high growth, and you'll do better on your equity than you will ever done on your debentures. Or together we can sort of, be in a life raft adrift at sea. And I really felt that this is one of those instances where there was no sort of agency difference between the outcome available to the debenture holders and what the equity holders needed in order to give a lift. So I'm grateful that that vision that I felt was sort of self-evident was adopted by the debenture holders. And you've raised a really important point here which is you got to get out in front of that, even if it is unsecured debt, like in our position. I began this initiative with a presentation to the board before I was the CEO, a good 16 months before those debentures came due, 16 or 17 months. So like as you get closer to that sort of date, that, time bomb date, your sort of ability to negotiate in good faith without the leverage of the debenture holders overwhelming you recedes. So I will give myself some credit, having been through a number of these companies now, not to believe like the idea that don't worry, it's all gonna fix itself in the next 6 quarters, maybe, but I don't want to leave it to chance. I always like to say, Santa Claus may not come down the chimney with presents this year, so you got to be prepared. And I have no problem with that analysis. I think it was the right analysis. What I hope is that the debentures holders who have converted will, make alpha as the stock, I hope and believe, will rise in accordance with our more disciplined financial sort of literacy as to how we run this company.
It'd be really difficult to see the share price or the market cap going down much further than it has without some catastrophe. I feel like the valuation right now is like more than fair if one is looking to potentially make multiples. But there are some people out there who hold warrants and not debentures. We had a few questions from people asking if they're going to get looked after in the same way. Any chance of repricing those warrants?
I'm not certainly in a position at this forum to make any undertakings except to say that we value the input of all our constituents, and I cannot make any undertaking. There are a number of warrants at different strike prices. I think it's fair to say that, management is looking at everything we can to improve the welfare of this company. And if there was a reasonable argument to be made that repricing a warrant was in the best interest of all the stakeholders, not just those warrant holders, well, then it's a no-brainer. We do it. But right now, that is not the most urgent priority. Our urgent priority is continuing to grow the revenue, economize on the expense, improve our gross margin, improve our sales and distribution to these 71 retail accounts that we mostly sell to completely in Nevada, and grow our Canada hemp business. And then we'll, as we get closer to sort of warrant expiration dates, we will revisit it. But to all those that are in that class, I hear you. I myself have, from my purchase of units in the company almost a year and a half ago, have a huge amount of options, not warrants, warrants out of the money. I mean, like, they're so far out of the money that, not to say that they won't get hit again, but they may not. So I'm sympathetic, I understand. But right now, I think the company has to focus on its most urgent priorities, and that at the moment is not our most urgent priority.
Among those priorities is another round of financing in the near future?
You know, anyone that is in this industry has to keep one ear tuned to the capital ground to say, what is the appetite? Personally, I don't like raising money at our current stock price. I think that I'm like every public CEO. Hey, I think my stock is undervalued. Hardly unique, but I'll say I backed up that thoughts by putting my own capital into the company, and we'll continue to buy our company stock. I played our last private placement. I've been buying on the open market. So right now, the company's analysis is that it has all the capital it needs to get to profitability and cash flow positivity. That being said, people have come at us. You know, it's an amazing thing when you close a round. You know what happens? All of a sudden, hey, people pop up and they're like, I would have liked to have invested. So right now, we're not absolutely prioritizing, but if we had an opportunity where I felt we had the right investor with the right amount of capital, we at least would give it an open look. But I do find that right now our market cap is roughly around more or less 18 million Canadian dollars. I'm confident that within the next year, that's going to be less than a year's revenue. Not certain. That's not a rep or a warranty or a guarantee. It's just my honest analysis about where the company is right now. And I'm hopeful that through the necessary amendments we've made to the debentures, through the money we've raised, through increasing sales, that we actually don't need to bring money in right now. And that we will convert all the debenture holders before that liability is due a year from now, in which case we'll hope that the stock price will allow us at that point to reconsider another private placement at a valuation that we think is more accurate relative to the company's position in the market right now.
Is a reverse split potentially on the cards, or is that something that you wouldn't entertain?
I'm against it right now because my find is that it's a failing. Just empirically, I found this to be a failing strategy. And I kind of agree with something you said, which I think is astute, is that sort of psychologically, and, you know, I never want to say our stock can't go lower because I'm inviting the gods of stock pricing to throw thunder and lightning down on my head. But I think psychologically, we're about more or less at a floor here. And if we did like a 20-to-1 or something, and now the stock is at $1.20, even though nothing's changed, the valuations that change, psychologically, it's easier to bet against the stock because there's more of a gap to go to. There's no methodology that doesn't quantitatively make any sense, but human psychology and stock markets often are not rational. They're engaging and they're sort of like reacting to emotional. So right now, there's no intention to do any sort of share conversion at the moment.
So the plan as it stands is to be very careful with your outgoings, be very greedy with your incomings, and get closer to that break-even point. How long do you think, being as this is your laser focus, should it take to get to a place where you're near that mark?
Yeah, so with the obvious caveats that I don't want to make a forward-looking statement that should be relied upon when making an investment decision. I'm certainly not to tell you my opinion, and that opinion is not based on hope and whimsy. It's based upon empirical data. I think we're going to be cash flow positive, or if you prefer the term profitable. As we know in cannabis, they're not always the same. So I'm going to say cash flow positive because that's something we all understand. That's when more money is coming in than is going out. I think we're a quarter, maybe a bit more than a quarter away. I even think that this month, October, as like just as a single month and without, you know, amortizing expenses that would be realized, like this is not perfect accounting, but even this month, I think we're pretty close to what could be a cash flow break even. We'll see. It's only the 6th. We're going to have to sell more product than we've sold in the first 5 days of the month, but so far the month's off to a reasonably good start. And we think that really basically with no less than say $1 million US of sales, we think that's getting us pretty close to the line. And our projections based upon our capacity are that we have the ability now with paid up infrastructure to do up to $1 million US per month in flower, and pre-rolls up to $1 million US in concentrate, and even beyond $1 million in our Canna hemp line, our non-psychoactive ability to ship across state borders. Now, we're not going to hit that number this month, let me assure anyone listening, but that's paid up capacity that we have. And there is right now, as much as I've ever seen, demand for high quality indoor grown flower in Nevada. It's just one of those things. I've never really seen a market which has an oversupply of truly high quality indoor, 28% THC with good terpene profile. That's the kind of flower we're peeling off right now. So we're pretty optimistic that we will be able to hit those numbers in the next, like the max numbers that I've outlined in the next year or so. But to get to cash flow positivity, we're not far away, in my opinion. We're not there for clarity, but it should not take us quarters and quarters. It should be measured in months right now, no more than that. Absent sort of another black swan event disrupting everything I know and believe, but just on the course we're on right now, we're pretty close, in my opinion.
Do you think that that 1933, a lot of stocks went on a big run over the last couple of years and then came back over the last couple of years? A few companies missed that big run, but still got sucked down when things went the other way. Do you think that 1933 is one of those?
I mean, you could put it on a chart. You could see that it sort of was on a lag, if you will. It had its big run before some of the other US operators had their big one. It was well promoted in Canada. Like a lot of early cannabis stocks, it was kind of a promote as much as it was as an operating business. And we've seen that the fate and fortunes of promotes don't usually hold up. But yeah, not to put too fine a point on it, but it's been in a steady decline now for 6 quarters in terms of stock price. I think it hit its most, I think it was around 63 cents in April 2018, which happily was a premium to what I had invested in back in earlier that month. But since then, it's been a slow grind down. And then I would have to concur with you that for reasons that are not entirely clear to me, it's gotten more beat up and hasn't had sort of that relief rally yet. But on the other hand, inevitably, the market will have to deal with financial reporting. Our liquidity has been pretty good. There's days where we still trade between our two markets, our OTC and our CSE, a few million shares if we've got something to move. So there's people with eyes on the stock. But I'm confident that at the end of the day, it's not going to be about press releases about some new licensing deal we've signed or some new technology maybe we've backed into. It's going to be about here's our revenue, here's our expense, here's our profit, here's our growth. And that's what will move the stock. But I do think the market's listening now, and I'm confident that we're, myself and my colleague Gene, our CFO Trisha Kalin, that we are understanding what the expectation of investors are, and we're not mistaking anything other than solid financial metrics in order to deliver what those investors are expecting. So that's why I keep saying this isn't about, there's no, an expression I'm fond of is at this point in cannabis, there's no silver bullets, there's lead bullets. You need a lot of them. And so I'm not operating under any illusion that there's some like quick fix. There's not. You got to fix these businesses. You got to look at it like a garden and go through your garden and say, okay, we have too many weeds and there's too many leaves blocking out the sunlight, but actually there's a lot of beautiful flowers here. So we just have to tend the garden a little bit better and then let everything happen organically. And while I still hold my breath and still have my eyes riveted to the road, I got to say, I just feel so much more relaxed about where this company is right now. And I would tell all investors from the CEO's role, I feel that we've come through a storm. I'm not saying it was a previous management storm, but it was a storm none the same. And I feel that we're now in smooth water, where our boat's not going to capsize. Well, I'm really into different analogies today, but I'm going to stick with that one. And now we're starting to pick up some wind, and I'm confident we're going to start moving quickly.